Good afternoon, everyone, and welcome to today's webinar in partnership with CloudTax. My name is Ted Ng. I'm the Director of Client Acquisition and Retention at Qtrade. Thank you for taking the time to join us. Before we get started, just a few quick housekeeping notes. Your camera and microphone will be turned off during the session, but we encourage you to ask questions using the Q&A feature. We'll be answering questions at the end. If you don't get to yours, we'll follow up after the event. If you experience any technical issues, try exiting and rejoining the session. We'd also really appreciate your feedback. A short survey will appear at the end of the webinar. Now, I'm pleased to introduce our speakers from CloudTax. First, we have Fred Zhuang, a CPA and tax expert who helps Canadians file accurate tax returns and bring experience from Intuit Canada. We're also joined by Pallavi Iyer, a CPA and senior tax manager at CloudTax, with extensive experience across personal and corporate tax filings. She also brings experience from Deloitte and Gibson and Graham. We're excited to have them here today. Now, before we begin, I'll quickly cover our disclaimer. This webinar is for informational and educational purposes only. It is not intended as investment, financial, or tax advice. Online brokerage services are offered through Qtrade Direct Investing, a division of Viso Financial Incorporated. Please note that investments are not insured by Canada Deposit Insurance Corporation or any government deposit insurer. With that, before we begin, one quick note on questions. We'll focus today's Q&A on tax questions for our guest speakers and follow up after the event on any Qtrade specific items. With that, I'll turn it over to Fred to get us started.
Thank you, Ted, for the warm introduction. So let's go ahead and get started. So for the agenda today, we're going to have 6 topics where you can see on the screen. The first 3 topics are more introductory. It's on tax strategy, income stability, and tax efficient investing. And then the next 3 topics will be a little bit more advanced on capital gains, estate planning, year-end checklist, and these will be covered by Pallavi. And then we will have a software demo after that, and we will answer as many questions as we can during the Q&A session. And as Ted mentioned, if there's additional questions that we cannot get to, we'll try to follow up after that. So we do have a bit of a promotion. If you're interested in, you can scan the QR code or just email hello@cloudtax.ca to receive the current promotions. Currently, we offer 2 options to help you simplify your tax filing. Option 1 is you can do your own tax DIY using our software. It works both on the web browser and on the phone. And we'll show you a demo exactly how easy it is to use it. Option 2 is if you need additional help, you can request an appointment for a review or a done for you. This year, CRA has massively improved their audit system to flag issues. So if you do have some complicated tax situation, it may be a good idea to get professional help. We do have bank level security encryption, so we make sure that your data is secure. So we're going to start with the first 3 main tax topics. The first one is on the why the tax strategy matters for investors. So here you can see the marginal tax rate on the highest level in Ontario. So you can see here, if it's earned with a active income with like $100, either active income or interest income, the government is going to take more than half. If it's capital gains, by the tax rule, only 50% is taxable, so the tax amount is roughly half. And if it's eligible dividends, it's a little bit lower than the active income, and the reason for that is the corporations where they're eligible, they have already paid corporate tax on the highest level, so therefore it's going to be a reduced rate when it gets passed through to the individual level. Just beyond the numbers that you see on the screen, we also have to recognize the capital gains are not only the lower tax amount, but they're also tax deferred. The earnings are from the active income and the dividends, they're taxed in the year that you as the taxpayer receive, but the capital gains is only taxed when you sell either the stock or the property. But at the same time, there could be volatility on the capital gain, so it really depends on the price that's sold. So just based on looking at the rates, we really want you to see that it's critically important to keep this rates in mind and think about what is the best way to structure the investments. Next point on this part, there's 4 income splitting strategies we want to cover. Hopefully these will help you. So in Canada, we have a progressive tax system. The more income that we earn, the higher the tax rate. The purpose of income splitting is to legally spread the income across family members who may have a lower tax bracket than the main earner. So effectively, it will reduce the overall tax for the entire family. The first one is the prescribed rate loan. So assuming this one, the taxpayer is at the highest tax bracket, and perhaps the spouse is on a lower tax bracket, the taxpayer can lend the money to the spouse at the CRA pre-approved prescribed rate, roughly 3%, and it will pay tax on the 3%, and all the earnings from the investment, it will be taxed at the spouse's lower tax rate. One thing to keep in mind is the interest. It needs to be paid by January 30th of each year. Otherwise, CRA will cancel the arrangement. And also on the financial point of view, if the prescribed rate is 3%, the investment that we're making, it has to make more than that. And also, remember the capital gain is taxed at 50%. So the investment, it need to double that for this to work. And just be mindful that if we're going this route, hoping to save money on the taxes, just make sure that we understand the calculations. It need to be at bare minimum more than the 3% the interest that we have to pay. The second point is the spousal RSP. So this one, the idea is the taxpayer will contribute to the spouse's RSP using the taxpayer's RSP room. And the gain from this part is the taxpayer instantly gains the tax deduction, and the spouse will only pay tax when they withdraw the funds, either at retirement or perhaps in a later year where they have a lower income. So effectively, we're transferring the tax liability from the higher one to the lower one and end up with a gain overall. One thing to be very mindful on this one is there is a 3-year attribution rule. So the taxpayer, you cannot transfer the money to the spouse and immediately the next year the spouse withdraw the money. The spouse has to wait at least 3 years. Otherwise, the tax will be at the earnings, it will be attributed back to the taxpayer, and they will have to pay the highest tax rates. Just make sure we're mindful of this. And also, this arrangement is irreversible. So if you contribute to your spouse's RSP and you later decide that it may not work as you intended and you want to reverse it, that's not allowed under CIA rules. The next point is the pension income splitting. So this one, the good thing is up to 50% of the actual pension can be allocated to the spouse every year with a joint election, T1032 joint election. The good thing is by doing this, the income is effectively split between the two spouses, and the tax perhaps could be lower. But things to keep in mind for this one also is by increasing your spouse's income, if they were at the lower tax bracket and they had a age amount, for example, that require them to be have annual income less than 45,000, and you as the taxpayer do the pension splitting and end up making their income more than that, there is a possibility that they will lose some of the the credits that the CRA is providing them. So just be mindful of that. The other thing is not every income is eligible for pension splitting. Usually the RIF annuity payments, if over 65, they qualify. Regular RSP withdrawals, any active income, any employment income, old age security, these do not qualify for pension splitting. And of course, this option also doesn't benefit singles. The last point on this part is funding your spouse or adult child's TSFA, the tax-free savings account. The benefit of this option is there's no attribution rule within TSFA. So that means the money that is contributed to the TSFA, it won't be taxed back to the contributor, even if it's withdrawn within the 3 years, unlike the RSP. The main reason for this is there is no upfront tax benefit in TSFA either, like the RSP. So therefore, they don't have this attribution rule. One thing to also keep in mind for this option is it is also irreversible. So once the taxpayer make this contribution to the spouse or the adult child's to the TSFA, and if something happens within the family dynamics or the relationship, you cannot legally force them to return the money. So, and then this part we're looking to compare the main tax shelter accounts. These ones I think everybody is very familiar with, the RSP, TSFA, FHSA. So aside from the general idea that everybody mostly knows for RSP is immediately tax deductible, every single amount that's contributed to RSP immediately reduce the current year tax liabilities. So it's really the best use when the taxpayer is in a higher tax bracket. One other thing that is very important is if the taxpayer make a contribution to RSP and then subsequently goes bankrupt. So the 12 months, if any contribution made prior to the 12 months rule, the creditors cannot go after the amount. So if you make contributions up to 12 months before the taxpayer declares bankruptcy, the amount in the RSP is protected. The other thing to be mindful for RSP is the gains within the RSP is tax deferred, but not tax exempt. So when we make a contribution to RSP, we do not pay the tax at that point, but when we withdraw the RSP on a later date, we still have to catch up on the tax. And also the loss within your RSP, if during any unfortunate events you see a loss, is not tax deductible. There is a mandatory withdrawal date, December 31st, when the taxpayer turns age 71. So make sure we plan early on the withdrawals. If you are a non-resident, there's no new RSP loan, and there could be a 25% withholding tax less any tax treaty amounts. If we compare RSP with the TSFA, so this one roughly is $7,000 in this current tax year, and if we have never used the amount since 2009, we could have roughly $109,000 in the contribution room. So all the contribution that we make within the TSFA, they're basically tax-free. There's no impact to OAH security or GIS. Things to be mindful with TSFA, same with the RSP, the loss is not tax deductible. So if you make gains, it's not taxable. The losses works exactly the same. It's not tax deductible. The TSFA differs from the RSP where it is not protected from creditors during bankruptcy. So if the taxpayer goes bankrupt and they have money in TSFA, the lenders, they can go after them. But if it's in RSP and it's after 12 months, they cannot go after them. So there's a difference there. We also cannot do like frequent tradings within TSFA. So you cannot buy like options or day trade in TSFA. That would be, in CRA point of view, deemed as carrying a business, and it will be taxed at the highest marginal tax rate. Same with the RSP, the TSFA, there's no new contribution room if the taxpayer become a non-resident. The last one on this part is the FHSA. So this one is the first-time home savings account. So this one is introduced in 2023. It combines both the attributes of RSP and TSFA. So there's a lifetime limit of 40,000 or 8,000 per year. One important distinction for this one is the FHSA, the contribution need to be made before the December 31st of the tax year. So the RSP, you have 2 months after year end to still be able to make the contributions. But if it's FHSA, the contribution need to be made before December 31st. There's a limited lifetime maximum, 40,000. There's a time limit. It need to be closed within 15 years or by age 71. There is a strict purpose restriction. The withdrawals has to be for the purpose of buying a new home. Otherwise, it will be taxed. The contribution carry forward is limited to the 8,000 per year. So if it's not used, it's lost. The non-residents will be subject to 25% withholding tax, less tax treaties if they make the withdrawal. And also this first-time home savings account is not to be confused with the home buyer plan. The other one is more associated with the RSP. So the other one, you can buy the home and there's a 60K limit. It has to repay back to the account. But this one is not to be confused with that one. This is a different threshold. So that's the main parts for the tax shelter accounts. I'm going to pass it to Halavi to cover some more advanced topics.
All right. Thank you so much, Fred. That was just an amazing presentation. And hello, everyone. My name is Pallavi Iyer. I'm Senior Tax Advisor with CloudTax, and I'll be taking you through the next part of the presentation. Looking forward to connecting with all the wonderful audience out there. So here we go with the next slide. Not all investment income is equal. Earn the same after-tax return with a lower gross yield by choosing the right type of income. So let me quickly walk you through why these numbers matter. And yes, we are using Ontario's top tax rates to make the impact very clear. So starting with the interest income, think GICs, bonds, saving accounts. It's taxed just like your salary. So if you earn $10,000 in interest, you could end up paying around $5,300, which is like 53.53% in taxes, and keeping only around $4,600 in your pocket. Now, that means you lose more than half of your income to taxes, which is why interest income is considered the least tax-efficient form of investment income. So basically, you do the work and CRA says, thanks, we'll take a big cut. So now the next is now capital gains, much nicer. Only 50% is taxable. So on, let's say again, $10,000, you're taxed on just $5,000. And end result, you keep a lot more, around $7,300 in your pocket, because the tax rate, as you can see on the screen, is hardly 26.76%. So compared to interest income, you're keeping significantly more on the same earnings, which is why capital gain are considered highly tax efficient. Then we have eligible dividends. They get special treatment with tax credits. So they land somewhere in the middle, better than interest, not quite good as capital gains, but still respectable. So if you earn $10,000 in dividends, you would pay roughly $3,900 in tax and keep about $6,000 in your pocket. So here's the interesting part, pre-tax returns. Because each type is taxed differently, you actually need less return from capital gains or dividends to end up with same money in your pocket as interest. So essentially, you can earn less, still keep more. For example, to achieve the same after tax return as 5% interest income, you only need about 3.17% in capital gains or 3.83% in dividends. So this means you can earn less before tax, but still end up with the same amount after tax. So, bottom line, it's not just about how much you earn, it's how you earn it. Interest gets taxed the hardest, capital gains are the most efficient, and dividend sits comfortably in between. And that takes us to our next slide: donate, invest, and plan your state. So, on this slide, I want to show you two different ways of donating investments, specifically shares, and why one option is much more tax efficient than the other. The two choices are selling the shares and donating the cash, or donating the shares directly. Now, let's walk through a simple example. Imagine you own shares that cost you nothing and are now worth $100. That means you have $100 capital gain. If you sell the shares first, that $100 gain is triggered. Half of it is what, $50 is taxable. Assuming a tax rate of around 50%, you end up paying about $25 in taxes. Now, after selling, you donate the full $100 in cash and receive a donation tax credit of $50. When you net everything out, you have paid $25 in tax and saved $50. Your net tax savings are $25. Now, let's look at the second option, donating the shares directly. And in this case, you never sell the shares. So there is no capital gain tax at all. Taxable portion is zero, and the tax payable is zero. So you still donate $100 and you still receive the same $50 donation tax credit. And this time, because you didn't pay any capital gain tax, your net tax savings are full $50. So here's the key takeaway. By donating shares directly instead of selling them first, you completely avoid capital gain tax and still receive the full donation credit. Result is simple: you double your tax savings, going from $25 to $50. Donating appreciated shares instead of cash is one of the most effective ways to maximize your tax benefit. However, I would like to just, quickly highlight one point here. There are a lot of tax nuances involved when it comes to practicality, while handling the tax situation in these terms. So it's always advisable to take a professional help. Right now, what we are trying to do is to give you the most simplest version of the topic so that you can just understand the baseline. Okie dokie. So that takes me to my next slide: state and US tax essentials. All right, so now let's talk about state planning, essentially making life easier for your family and avoiding unnecessary tax issues later. So if there's one key takeaway here, it's this: always name beneficiaries on your registered accounts. For example, let's take one by one the points you can see on the screen. Name our SPA and RIF beneficiaries. So this one is a quiet hero. If you name a beneficiary, especially your spouse, the assets skip probate altogether. So it's faster, cheaper, way less paperwork, which we all love. So even better, if it goes to a spouse, it rolls over tax-free. So no tax today, and CRA just politely waits its turn. But if you don't name a beneficiary, the full value can become taxable right away, which basically means CRA shows up uninvited, takes much bigger slice than necessary. Next point: spouse as a TFSA successor holder. So when it comes to TFSA, terminology can get a bit confusing, but the difference really matters. If your spouse is named as a successor holder, TFSA just continues as is. No tax, no interruption, no drama. It's the financial equivalent of a smooth, direct flight. But if they're named only as a beneficiary, it still bypasses probate, which is great, but TFSA itself ends. And now you have got a bit of turbulence to deal with. So same destination, but one comes with a comfy seat and snacks, and the other has unexpected bumps along the way. So that's why successor holder is usually the better option. It keeps everything intact and avoids unnecessary complications. That takes us to the third point: defer capital gain on death. So, from a tax perspective, at death, CRA applies something called deemed disposition. So, in simple terms, they assume you have sold all your assets at fair market value right before death, even though you obviously didn't. So, yes, on paper, everything gets sold, and any unrealized gains can suddenly become taxable. Not exactly the kind of surprise anyone wants, and it can lead to pretty large final tax bill. And that's why planning ahead really matters. Otherwise, taxes tend to show up at the worst possible moment. Now, here's the good news. There is an important exception. If assets pass to your spouse or a spousal trust, that tax hit is deferred. Basically, CRA is saying, all right, we'll let this one go for now, but we will be back. What this means is no tax at the first death, which can make a huge difference in preserving wealth and avoiding a sudden financial burden for the family. So, what's spousal trust? So, think of it as a setup where your spouse gets to enjoy the benefits of the assets during their lifetime, like income from interest or dividends, but the assets themselves are protected for the final beneficiaries, usually the kids. It's structured and intentional and keeps everyone taken care of. Now, you might wonder why not just transfer everything directly to your spouse? Fair question. The tax result is same, you still get the deferral, but the difference is control. So, with a direct transfer, your spouse has full freedom to do anything with those assets, including changing who eventually gets them. With a spousal trust, you're essentially setting the rules in advance. So, it's a nice balance. You're taking care of your spouse while also making sure your long term plan for the family stays exactly as you intended. I just want to touch base quickly on the estate planning basics as well, which is will and power of attorney. A will helps control what happens at death. It allows for tax efficient transfers like spousal rollover and helps avoid unnecessary taxes and confusion. Without it, you lose that control. Power of attorney works during your lifetime. It ensures someone can manage your finances and handle tax matters if you're unable to. So nothing gets missed or delayed. So simply put, will manages taxes at death and power of attorney keep things running smoothly before that. That takes us to the fourth point, and let's quickly touch on US state tax because this is where things can unexpectedly get complicated. It's something which I just want to, quickly highlight here, but we're not going to go deep into it. If your US situated assets exceed $60,000, you may need to file a US state return using IRS Form 706 NA. And remember, filing does not mean paying taxes, it just means you're required to report. So while the filing threshold is $60,000, the actual tax exemption is much higher, around 13 million or $15 million. But here's the catch. You don't get this exemption automatically. You must file the return to claim it. And the last one, I think most of you must be aware of it, which is file form 1135. So, briefly talking about it, it's a foreign reporting. Total cost of your non registered foreign property exceeds 100,000 Canadian dollars. At any point during the year, you are required to file this form along with your personal tax return. And this includes like foreign stocks, ETFs, maybe real estate held outside Canada in the nature of, rental property. And CRA takes this form very seriously, and penalties for not filing can be quite high. So it's kind of important that you don't miss it out while filing your personal tax returns. And here we go to the next slide now. So this slide is a 2026 tax action checklist, basically a timeline of what you should do and by when to optimize taxes in Canada. So I'll walk you through it in a simple and practical way. So the deadline-based tax planning list is past means already missed, to do is still actionable, always means ongoing strategy. So let's start with first one, January 30th. It's a key deadline for anyone using family prescribed rate loans for income splitting. Fred explained you that earlier. The idea behind these loans is to shift investment income to a lower income family member, but for the strategy to remain valid, interest must be paid on time every year. Next is March 2nd, which marks the last day to contribute to your RRSP for the 2025 tax year. And contributions made by this date can be used to reduce your 2025 taxable income. Next, again, it's December 31st. So if you're turning 71 that year, it's your final opportunity to contribute to your RRSP. After this point, you're required to convert your RRSP into your RIF, which means shifting from the saving phase to the withdrawal phase. And that certainly needs some sort of tax planning there. Again, December 31st, which is to make sure you're maximizing your TFSA contribution with 2026 limits set at $7,000. Key advantage here is that both growth and withdrawals are completely tax-free, making it one of the most powerful and flexible investment tools available. Then again, considering donating appreciated securities instead of cash, we already covered that in the previous slide. So this way you avoid paying capital gain tax on the increase in value while receiving a full donation tax credit. Next is again considering opening an FHSA. If you are a first-time home buyer, this account gives you best of both worlds with a tax deduction on contributions like RRSP and tax-free withdrawals like TFSA when used for a home. And make sure to file tax returns for children who have earned income. Even if no tax is payable, filing help build RRSP contribution room early. So yes, retirement planning can technically start at 16, let's say. Finally, contributing to an RESP to take advantage of the government grant. You can receive up to $500 per year per child, and which is essentially a free money towards education if you contribute on time. So finally, this is a year-round strategy, asset location. The idea is to be intentional about where you hold different types of investments. Interest income, which is fully taxable, is best kept inside registered accounts like RRSP or TFSA. On the other hand, capital gain and dividends are more tax efficient, so they can be held outside in non-registered accounts. A simple way to remember this is put your taxed income in your tax shelters first. And with that, I'll wrap up the presentation. Your brain have officially survived the tax talk, so well done. Now that we have discussed the investment strategy, let's shift gears and take a look at how CloudTax simplifies the tax filing process. So we offer a range of solutions tailored to the level of support you're looking for, whether you prefer a hands-on approach or guided assistance. So with that, I'll hand it over to Fred to walk you through a quick demo. On to you, Fred. Thank you, everyone.
Okay, thank you, Pavi. We're just gonna go ahead and share screen to take a look. So this is the CloudTax interface. Is extremely easy to see. So you can see here, there's a top ribbon on the where it says personal info, my forms, provincial credits, a review, and a submit. And then on the left, there's a list of information. So when you sign into your CloudTax account, and you can do this on the phone and also on a web browser. It works on both. So you sign into your account and it will just, everything here is going to be automatic. You just enter your information. If it's a couple, you can just put the name here. I just made a demo one here, and none of these are actual numbers. So just put your own actual name on here. And if it's a couple, just file with as a family. You can change it. If it's just a single person, it will just be one return. And then just follow the steps that you see on the screen. Just enter all the basic data here. Once we're satisfied with this page, it will just move from the horizontal line on the top in sequence. So personal info and then my forms. So here you can add the different forms. You can add them manually here at the bottom. Just click my form and just search. If you need to add a T4, you can just click it. Alternative, the proper way and the faster way is just use the CRA autofill, and it will just automatically import the data from your CRA account. If that didn't work, like maybe you want to file the tax a little bit early, or maybe you don't have all the slips, you can also use the drop your slip. You can just upload the PDF document. The software will automatically read the slip, and it will just import the data. So once you're satisfied with the slips and you see the numbers on here, normally what I do is, instead of trying to add every single slip and figure out if I have everything, I just want to know, like, I have see this one slip here. How do I know the information on this slip is going to be properly entered on the tax return? So you go to the review, and then on the left side, there's your PDF. This is the most important part. So you can see all the automatically generated PDF by the software. You're gonna look at the tax return, and then on this one, you can see it has 8 pages. The first 2 pages is the personal info that we enter, and then on page 3, this is the total income. So this number here on the tax form, line 10100, this employment income of 50,000. This is the number that got transferred from the forms, from the T4. So you know this number here got successfully transferred to the tax form, and this give you the confidence that the information is correctly entered. So make sure that when we are looking to, if we were to do this on our own, and we're trying to figure out how to use the software, and you enter a new form or new data, you always want to come back here under review, under your PDF. You want to check the number is on there, and that will give you the idea that yes, the number is correct. So then we can just keep going through the list. So all the forms here, it really just depends on what kind of situation that the taxpayer is on. So if they have only a T4, then you will not see any of this. But of course, everybody here probably have some investment. So all the slips that you normally have in your CRA account, all the T3s, T5, T5008, all the forms, it will automatically be in your CRA account. And when you do the autofill, they will automatically be generated in the forms, and you can just add the numbers. And once the numbers are added, you can just scroll up and down, confirm, yeah, this is correct, this match to the slips, and then check under review, under the account, to see that number is there. One thing that is a really good function that we have is under the T5008, the security transaction. This one, if it's filing as a couple, you can automatically split the gains between the husband and the wife, and you click this 3 dots over here, and you can just prorate the shares between the 2 parties. So if it's capital gain for the whole family and it should be allocated in a different rate, you can just go ahead and change this. Once you are satisfied with this, you just update the amount, and it will update the entire tax return. If we have other income, like it will just get reported here. Like if we have the prescribed rate loans, it will go on here as other income. If we have foreign, let's say we buy some dividend paying stocks or on Qtrade, and there's foreign income and there's foreign tax credits, that will go on here under T2209. So usually what happens is, if we invest in a foreign dividend paying company and they issue a dividend, they automatically already deduct like if it's from US, they already have the tax deducted. So our job, you want to make sure that you put it on here, which country it's from, and then the amount received, and just put the foreign tax paid. This number here on the foreign tax, it will go onto your PDF under the T1, somewhere near the end, there's like a foreign tax credit amount here. Use the control find. So you can see here, there's a federal foreign tax credit from form T2209. So line 40500. So if you're looking for a line item and you don't know which page it is, you can just use the control find on the spreadsheet and just look for it. So if we had a foreign taxpayer, it will go on here, and it will automatically add to the tax that we have already paid. And then once that's added, that number is going to be compared to the tax withheld, and the net amount is going to be either a refund or tax owing. So this will make sure that we're not paying the tax twice. If we end up having an investment from a foreign country and we pay tax in their country, we'll put the number here so that we don't pay it again in Canada. Other than that, the forms is extremely intuitive. It's very easy to use. All the regular medical expense, donations, any employment expense, you can add everything on here. So this is the main point for my forms. You just follow the instructions to do this. And then the other thing is the provincial credit. So this one, it really depends on which province you're in. If you're in BC, there's a BC rent credit. It will automatically show up here based on what you put under the personal info. But if we're in Ontario, the main one, almost everybody is claiming this one, is the Ontario Trade Benefit. This one, you just put a yes on this, and then just fill in the forms. If you pay rent or property tax, just put a yes on this one. Put whatever the amount that you paid, and you will get a confirmation this is going to be sent within the tax form, and then you get a refund for this, applying for this. So this is one of the main provincial credit for Ontario. And once we're satisfied with everything on the forms and also on the provincial credit, and we make sure the names are correct. Every year I get a question on the middle name. There's somebody with a middle name that may have issues with filing the return. So if you have a middle name, you have to make sure that everything that you enter on the tax office need to be an exact match to what you have in your CRA account. Once we're satisfied with step 1, 2, and 3 with personal info forms provincial credit, you go to review. And then you're just gonna air check the return. If there's no issues, then you can go ahead and submit the return. And then once you submit the return, you get like a confirmation code from CRA, and you also get an email if you registered, and then that will be your tax return done. And so it's extremely easy to use. It's very intuitive. So that's the main point for the demo, and I think I will pass on to Rainey to talk about the current promotion that we have.
Thank you so much, Fred. My name is Arnie from CloudTax. So if you have any questions, please use the Q&A box. Depending on how much time we have, we'll get through as many as possible. And before we dive into the questions, I'll quickly recap the exclusive offer available to Qtrade users. With CloudTax, you have a few flexible options depending on how hands-on you want to be. First, the do-it-yourself option. You can use the CRA autofill or use our AI technology to scan and import your slips, and the numbers will be entered for you. It's pay what you want, so you can file for as little as $0. If you like to file on your own, but you also want that extra support, you can upgrade to CloudTax Plus at a discounted rate for Qtrade users, and this will give you access to expert guidance. You can chat with the CPA and ask personalized tax questions as you file. And if you'd rather not deal with taxes at all, you can use our Done For You service, where one of our CPAs will fully review or prepare and file your return from start to finish. So for more information, please head to cloudtax.ca/Qtrade. All right, with that, let's open it up for questions. So we have a lot of them. We'll try to get through as much as possible. So for my first question, I'll hand it over to Fred. In a non-registered cash account, am I taxed at the moment I sell a stock or portion of it, or only when I withdraw the proceeds from the account?
Yeah, so for any investment, regardless if it's registered or non-registered, it's going to be taxed on the sale, not the withdrawal. So the moment that you sell the account, even if the fund is still in the same account, it's going to be taxed. If it's registered, you're probably going to get a slip, whether it's a T3, T5, or any of the investment income slips. If it's on your own, you may not get a slip, but it's still a taxable capital gain, and it has to be reported when it's sold.
Awesome. Thank you. For Pallavi, if an investment becomes non-qualified while held in a registered account and is then transferred to a non-registered account, what are the potential tax implications of that move?
So I'll just try to give the most simplest version because there could be too many things involved in here. But when a non-qualified investment transfer to the registered or like vice versa. So first, there's a concept called deemed disposition. So when it moves out, it is treated as deemed disposition. So it's more like any accrued gain is taxable at that point. So capital gain, as you know, 50% taxable. So if this happens, I would say just act fast, call a tax advisor, and make sure that you're not going to hit by any penalty by Revenue Canada, because in sometimes if you're late in reporting all this, CRA is pretty bad and brutal with the penalties. So make sure that you're aware of the deemed disposition situation in this, and of course the penalty tax you might get on it. So yeah.
Thank you. What are the key tax differences between dividends received from Canadian companies versus those from non-Canadian companies?
Yeah, so the
Okay, so
oh, go ahead.
Yeah, go ahead. Go ahead, Fred. I'll join you maybe in between.
Okay, I think the dividend, the Canadian company could qualify for a eligible dividend, and you will get a bigger dividend tax discount for that. And but if it's not a Canadian company, you don't get that discount. And also, if let's say it's a U.S. dividend, the before you even see the dividend money to your account, the U.S. they have already withheld 15% on the money. So if they advertise the dividend at an amount, what you're actually getting is 15% less of that, and you already paid the foreign tax on that. So that's the foreign tax that you paid is you're gonna have to remember to report that on your tax return to get the dividend tax credit, so that you don't pay the same tax again. But generally, the Canadian dividend, if it's eligible, which means the corporation has already paid the higher corporate tax rate, you get an additional dividend discount. If it's not eligible, you don't get that discount.
Awesome. Thank you. For Pallavi, what types of activity within a TFSA could potentially trigger a CRA review, and what should investors avoid to remain compliant?
Okay. So, well, that's an interesting question, though. So, main thing you need to remember is obviously stay within your contribution room. And one, I would say, the most popular area where CRA might, you might draw attention of CRA is when you are sort of doing a trading inside the TFSA. It's very sort of, frequent buying and selling of the stocks and shares within the TFSA. And this might, give us a slight idea to Revenue Canada that it's more like a business within that registered account. And this is something where you might trigger a Revenue Canada review. And secondly, they track your room and charges 1% per month on the excess amount. So make sure you are well aware what's your overall contribution room for the TFSA. And third is like holding non-qualified investments inside a TFSA. So keep it simple: index funds, ETFs, listed stocks, GICs. Avoid private shares or anything that could be speculative or that can be, easily thinly tradable. So yeah, that would, I would say, the most popular areas where CRA might trigger the review. Yeah.
Awesome. Thank you. The next question. I expect to receive approximately $400,000 in capital gains from the sale of a rental property. What strategies are available to help minimize the resulting tax liability?
Okay,
yeah, so for this one.
Yeah, go ahead.
Okay, go ahead.
So I mean, I guess I understood the question correctly. You're saying that you expect to realize approximately 400,000 in capital gain from the sale of rental property. So first thing, uh, this is not that straightforward. If you are about to go into this kind of transaction, you might have to first consider how that particular tax year is for you in terms of income strategy, right? And of course, the most I would say the common question would be, is this your principal residence? If it is, then of course, you know that um, principal residence is completely exempted from the capital gain. But there are situations where you might have changed the nature of the property, going through while you were declaring it as a principal residence. So then there are other tax nuances get involved that you might get taxed on the overall capital gain occurred there. So I would say just make sure that you're maximizing the deductions when you're, if you are exposed to the capital gain, then just all sorts of capital improvements you did, make sure that those sort of expenses are capitalized. Any lawyer fees, brokerage fees, all sorts of those expenses you take an outlay, deducted against the overall proceeds, so at least the capital gain is sort of optimized when it comes to the taxation. Of course, it's 50% taxable, but that doesn't mean that that 50% is not going to push your slab rate for that particular year. So certainly it does need your sort of tax planning for that tax year, considering all other sources of income. And yes, the most important thing is just in case you have a capital loss sitting there. So that would be a great opportunity to adjust the capital gain, because capital loss cannot be adjusted against any other source of income. It is certainly be adjusted against the capital gain. So you need to keep that in mind. You can just adjust the capital loss against capital gain and reduce it. And that should hopefully optimize your overall capital gain situation for that particular year. So yeah, I would say a lot I can talk about this, but this is the most simplified version as of now, I can say, with the interest of time. Thank you.
Thank you. I'll hand over the next question to Fred. Could you provide guidance on how to effectively claim medical expenses, including what qualifies and how to maximize the deduction?
Yeah, the medical expense has a few rules. The first one is how much. So the how much is the amount higher than 3% of net income, and the annual the lower of the 3% net income of and the prescribed threshold, I think is around like $2,900. So you need to spend more than that. If you are a high income earner, you need to spend more than $2,900 for the medical expense benefit. If the person is not a high income earner, they need to make sure that the income that they pay, there is sufficient room for them to receive the medical expense. The amount that qualifies for the medical expense, the first thing is you're going to look at the health insurance or medical dental insurance. You see how much is the out-of-pocket amount. So it could be the entire billing, but only the out-of-pocket amount is tax deductible. And the other thing is there's a list on the CRA website to describe what qualifies for medical expense. Generally, all the things that you normally see, dental cleaning, glasses, some of the general ones, they qualify, maybe like a chiropractor, massage, they all qualify. The third thing is, well, how can you maximize this deduction? So the tax rule is it need to be within 12 months ending in the current tax year. So that means if the current tax year is January 1st to December 31st, you technically could have a medical expense from December 1st of 2024, but you have a bunch of expense at the beginning of 2025, and that still is 12 months period within that with the ending time in the current year. So that give you a leverage where you can try to add up more expense than what would have happened in the current year. So based on this strategy, your main point is you want to spend all your medical expense at once within the 12 months period. You don't want to spend a big amount this year and then wait 13 months and then spend another big expense. If you do that and you have a high income, you may not get the benefit from the medical deduction because they were spread apart way too long, and the 12 months rule is not going to work in your favor. So just make sure if you have a huge medical expense, try to get them done within the year, and then that will give you the maximum refund.
Thank you so much. The next question, if I withdraw funds from my TFSA and give them to my spouse so they can contribute to their TFSA, are there any tax implications or attribution rules to consider? Pallavi, do you want to take this one?
Yeah, I'll take this one. This is again one of the very good strategy, I would say, when it comes to the tax planning and sort of avoid attribution rule in here. It's the first thing is, of course, no attribution rule applies here because it's within the TFSA account. So you are giving cash or funds to your spouse and they are eventually contributing to the TFSA. Whatever is growing, whatever the income addition is happening, it is inside the TFSA. So it's tax-free. Only thing is what CRA has, CRA usually take into consideration. Let's say your spouse withdraws those funds and then reinvest it outside the TFSA, outside the registered account. And that's where exactly I would say the attribution rule hit, because now the income earned on those reinvested funds would be outside the registered account and it will straight come back to you, I would say, if you are the one who's like sort of transferring the cash to the spouse. So as long as you are within the TFSA and your spouse is investing within the TFSA, it's fine. Moment it's out, funds are withdrawn and reinvested, attribution rule will apply. Yes, thank you.
Perfect. Next question for Fred. Can a prescribed rate loan strategy be used by a single individual? For example, lending to a friend instead of a spouse, and what are the tax implications?
Yeah, for this one, the main purpose, the CRA rule is designated to allow the taxpayer to do the income splitting for the family members. So the friend is not really part of the discussion here. So the main idea if the main goal is to do the prescribed loan to reduce the overall tax, it can only be done with a family member. For a friend, it may be possible to lend to like an arm's length, like a business type loan, but it's going to be a lot more complicated, and it's very likely that CRA will still attribute back the earnings back to the person that's making the lending. So this strategy is best working for lending within the family, not with a friend.
Perfect. Thank you, Fred and Pallavi. These are such great questions. Really appreciate it. If you'd like more clarification or if anything comes up after this, feel free to reach out to our support team at hello@cloudtax.ca, and we'll be happy to assist you. Thank you so much, and over to you, Ted.
Thank you, Rani. That brings us to the end of today's session. Thank you to our presenters and to all of you for joining us. We hope you found this webinar helpful as you navigate tax season. As mentioned earlier, you'll see a short survey on your screen. We'd really appreciate you taking a moment to share your feedback. A recording of the session will also be sent to you by email. From all of us at Qtrade and CloudTax, thank you again for attending. Enjoy the rest of your day.